How much money do you really have saved right now? And what does it actually take to be wealthier than 90% of people your age? In this video, we're breaking down 8 eye-opening money statistics that most people avoid talking about. Especially number 4, because that one could seriously change the way you think about your finances. By the end, you'll have a much clearer idea of where you stand financially and what steps you can take moving forward. Let's start with number 8, income. The United States ranks among the highest income countries in the world, with the average annual income sitting around $83,000. At first glance, that sounds incredible. But averages can be very misleading. Here's why. If one person earns $40,000 a year and another person earns $10 million, the average between them looks extremely high, even though most people are nowhere near that level. That's why economists often focus on the median income instead, the exact middle point where half the population earns more and half earns less. In 2024, the median individual income in the U.S. was roughly $45,000 a year. That means if you earn more than that, you already make more than half the adult population. But income alone doesn't determine wealth. Spending matters just as much. Someone earning $500,000 annually but spending even more is financially worse off than a person earning $60,000 while living on only half of it. Wealth is built by the gap between what you earn and what you spend. According to recent consumer data, the average American household spends around $78,000 every year. Meanwhile, the median household income is only slightly higher than that. So, for many families, nearly every dollar coming in is already spoken for. And where does most of the money go? The 3 largest expenses are housing, transportation, and food. Together, those categories consume the majority of a household's income before savings or investing even enter the picture. So, what does it actually take to feel financially stable? The answer is less about comparing yourself to national averages and more about how you structure your own finances. A practical approach is to dedicate around 50–60% of your take-home pay toward necessities, 15 to 25% towards savings and investing, and the remaining portion toward flexible spending and enjoyment. That balance matters because financial freedom isn't about deprivation. It's about making sure your priorities are handled first so you can spend the rest without stress or guilt. Now, here's the statistic that surprised me the most, because it completely changes how people think about building wealth. What's the average savings rate in the United States? Compared to many other developed countries, the U.S. savings rate ranks surprisingly low, and this number matters far more than most people realize. Imagine 2 people earning the exact same salary of $75,000 per year. The first person saves 15% of their income, but only earns modest investment returns. The second person saves almost nothing, but somehow earns incredible stock market returns. Most people assume the second person would build wealth faster. But in reality, the consistent saver wins, and often by a huge margin. That's because your savings rate has a bigger impact early on than chasing high investment returns. If you're not keeping enough of what you earn, compounding has very little to work with. The average personal savings rate in America recently hovered around just 4 or 5%, which is incredibly low. And with inflation making everyday life more expensive, having a solid spending plan matters more now than ever. But even if you're saving consistently, there's another financial number that's even more important: emergency savings. A large percentage of Americans say they would struggle to cover an unexpected $1,000 expense without borrowing money or using credit cards. That means millions of people are one emergency away from financial stress. A common recommendation is to build an emergency fund covering 3 to 6 months of essential expenses. So if your monthly necessities total $2,000, you'd ideally want at least $6,000 set aside for emergencies. And honestly, this should probably be the first major financial goal for almost everyone, because emergency savings don't just protect your bank account, they protect your peace of mind. Financial stability feels very different when unexpected problems stop becoming disasters. Now let's talk about how much money people actually have sitting in their bank accounts. While the average balance may appear fairly high on paper, the median amount Americans actually have saved is much lower, only around several $1,000s. For many households, that wouldn't even cover a few months of expenses. What's interesting is that age alone doesn't predict savings nearly as much as people assume. Yes, older people tend to have more money saved, but the gap is often much smaller than expected. Two things matter far more: education level and income. People with higher incomes and stronger career opportunities consistently end up with dramatically higher savings balances over time. That may sound obvious, but it highlights something important. Increasing your earning power can be just as impactful as cutting expenses. Now, here's where things get concerning: retirement savings. The median retirement account balance in America is far lower than most people expect. And nearly half of all Americans reportedly have nothing saved for retirement at all. What's even more alarming is that this issue doesn't disappear with age. A significant percentage of people approaching retirement still have zero retirement savings. That's why starting early matters so much. Even relatively small monthly investments can grow massively over time because of compounding. The earlier you begin, the more time your money has to work for you. By the time many people finally decide to start investing, they have to contribute dramatically more money just to catch up.
And that brings us to one of the most important financial measurements overall: net worth.
Your net worth is simply everything you own minus everything you owe. Cash, investments, property, and assets all count toward it, while debts reduce it. The average American net worth is over $1 million, but once again, averages are heavily skewed by the ultra-wealthy. The median net worth is far lower. Still, what shocked me most was discovering how much net worth you actually need to reach the top 10% for your age group. For many age ranges, the numbers are significantly higher than people expect, especially during your 30s and 40s, which are often the most important wealth-building years of your life. But here's the encouraging part. There are more millionaires today than at any point in history, and most of them didn't inherit their wealth. Research consistently shows that the majority of millionaires built their money gradually through consistent investing, disciplined saving, and long-term habits. Not lottery tickets or overnight success. And becoming a millionaire is far more achievable than people think. For example, someone who begins investing in their early 20s doesn't need enormous amounts of money each month to eventually reach 7 figures. But the longer you wait, the harder it becomes, because time is the most powerful factor in compounding. By the time many people finally decide to start investing, they have to contribute dramatically more money just to catch up. That's why the single most important step is simply getting started. Not finding the perfect stock, not timing the market, not predicting the next big trend, just starting. Because doing nothing is usually the most expensive financial mistake of all.